Hey Jason, Jim Munchbach here at Family Wealth Builder. Hey, I wanted to make a quick video just to walk you through your portfolio, to do a little review here. Thank you very much for taking my quick questionnaire. Your number, as you know, is 68. So what I did is I just imported your portfolio, your current portfolio, which is kind of cool. It's at a risk 67, so that means your actual risk in your portfolio appears to be very close to the risk number that you wanted. I'm showing you a side-by-side in this review. I want to just show you some things about your own portfolio. So I picked one of my models. It's a very basic tactical model based on the S&P 500. The risk for that portfolio, as you see, is 73. So I'm going to walk you through your portfolio. I know you're busy, so I blocked out any account numbers, hopefully. So all you see is your first name and your last initial and my contact information. So just so you know, I'm making this video for you, but I have another client who has the same issues, so I'm doing a video for both of you. But this is your review. So one of the first things I want you to notice, Jason, is that your risk in this portfolio, in your portfolio, the one that I'm managing for you with a lot of help from you, this risk is 67, but you have 12% in cash. So if we bumped that up, if we took the cash out and invested it, which I'm assuming is where we're going with your portfolio, that would raise your risk score in this portfolio to well over 80. I don't know for sure. It's probably, I would guess, 87 or so. So this just shows your current holdings. They continue on this page. So I'll just walk you through a couple of ideas. Also, I wanted to highlight this Comcast. You suggested we pick that up in your portfolio this week, so we did. We only picked up 1.5%, which is just fine, but I just want to show you the chart here. It's up 1.59% today. You keep doing that. You keep picking stocks that go up, but they're volatile. So my favorite investment of all time is this SPY. I'll talk more about that in future reviews if you want to know. But just to highlight Comcast, the reason I like that purchase, that investment, that buy, and the reason that I would suggest probably going somewhere around 3%, double what you did. And I'm good at second guessing you, but at any rate, I look at the chart, here's what I see. So this is a 2-year chart, and Comcast it's had a significant pullback in the 2-year chart. And so it's hit support. See how it's hit support down around, I don't even know, 30, about where it is. So that's a pretty sturdy support. And what happens with these stocks is they go up and down, but when they hit a support level, if they don't go through it, then they hold it and it becomes a good solid floor. And then there's a ceiling as well. So part of my job is to give you advice or recommendations as best I can about kind of the technical analysis of these holdings. Since this is a pretty small holding, I don't spend a lot of time on it, but I would suggest, you know, in the future when you make a buy like this, I might suggest we consider it as a bigger part of your portfolio. But this is why, because you bought this stock at a very good support level. Pretty good support here, as you see. It has more support here. It dropped through both of those. It has I would say, pretty good support here. But you bought it down here, which is, you know, to me, that means this stock has a lot less risk. I've done a little bit of analysis on what's going on with the company, and, you know, it's got some risk, but I think, in fact, I turned around and bought it after I bought it for you. I bought it in my own portfolio. So this is my portfolio that I built. It's not a proposal for you, but it's for reference. So you can see this is a 73 risk. You're at a 68. So this is a little more. But what's different about this is 100% invested. So there's no cash. If you look at the distribution on this portfolio, it's about 50 basis points higher than yours. and the expense ratio is lower. Some things I can do to help get your expenses down, and I'll be making those recommendations shortly. But this would be if I had a new client who wasn't sure how to invest and they had the same risk tolerance as you, this would be what I would call an aggressive portfolio. So this just shows you what I have held in this model portfolio. Typically, this S&P 500, like I said, it's my favorite investment on the planet, but I typically would break that out into the 11 sectors. I think it's 10 or 11 sectors within the S&P 500, and we would use those to manage in a tactical way the ups and downs of the market based on the business cycle, market conditions, market indicators like unemployment, and manufacturing orders and such as that. We use those dials, I use those dials to tell me whether or not we want to be more in the market with more risk or out of the market with less risk. And the other thing we look at is just plain valuation. So again, if we go back to Comcast, we can see that the valuation on that stock is very favorable because it pulled back so much. So same thing with the SPY. That's a reflection of the S&P 500, and right now it's pretty high. So the valuation is pretty high. So I'm not like, let's get all in. I'm more like, let's be careful, because the higher it is, the more risk there is. The lower it is, the less risk there is, just based on valuation. So the S&P 500, that's a very diverse ETF. Talk about that more, but it's the S&P 500. It pays a pretty good dividend. I like it. I love it. I trade it all the time. So it's like the real utility player in your portfolio, or in my portfolio. So this just shows your portfolio and where the returns are coming from, and I'll send you this report, but it shows diversified risk, straight up risk, and reward. So you can see those things here on each stock. So just take a look at that. Tell me what you see. I see, we just got out of Tesla a little bit today. It made sense to me. We set I think it was a 307 limit order. And in your portfolio, again, that's what I'm recommending we do systematically moving forward. I think that's a good strategy for you. And by the way, I like your portfolio. I mean, you helped me build. I didn't really build this. I made some recommendations. You generally take all my recommendations, and I appreciate your trust. But this is your portfolio. I just help you manage it. So back to the drawing board. This shows what we have. I wanted to highlight this Comcast again. It's 1.5% of the portfolio. But if you look, you can see it's pretty, just in general, it's a pretty good risk profile for your portfolio. So I would say 3% would be good based on where this is as far as risk, the valuation. And I like the stock. I don't love Comcast. That's who we're using right now. This is my internet provider. And by the way, I don't like them as a provider, but they're making money, a lot of money. So if we look at this just shows the current annual distribution. So it shows where the returns are coming from. I wanted to highlight this one for you, Jason, because this was one I put in your portfolio, and you can see that's pretty good return. This has a pretty good return. PIMCO. So the reason I highlighted these is because in just a second you're going to see those are pretty good returns. I typically like to keep the expenses low, and one of the things you're going to see here in just a minute is, sorry if I'm making you dizzy. I hate it when people do that on a screen share. It goes so fast you can't see it. But again, I'm going to send you this report and you'll see all my scribbles on here. But anyway, we're back to the expenses in your portfolio. So you can see this is that one I highlighted earlier, EFA. One of the holdings I put in had a pretty good return, competitive return, better than most, better than average. And the expense, pretty low. On the other hand, if you look at, PIMCO's a little higher, you look at this mutual fund, and these get to be pretty high expenses. But on the other hand, they're providing pretty good returns. So I just wanted you to know I'm keeping my eye on that. Some of these holdings, they have managers who specialize and they give us a better return, better than I'm going to be able to give you for any individual holding. So they're better returns than you're going to get from my favorite investment, the SPY, the S&P 500. I think that one's at 78 basis points right now. I should know, but it's decent, especially for the liquidity. So here's one of those sector funds that I like, and we will be talking more about that in the future. But anyway, this just shows the expenses in your portfolio. This is your portfolio. So, and then at the bottom, you'll see some stress tests on my report, like what happens if we have a bull market, what happens if we have a bear market, and so on. So, hope that helps. I am available to chat with you anytime, but I thought this would be a good way. Sorry, I didn't mean to make you dizzy again. I thought this would be a good way to just review quickly your portfolio, open some issues for you to think about, and kind of frame my recommendations moving forward. The number one is to consider a limit order strategy. When we get into a new position, we need to have a pretty good idea how we want to get out. I can help you with that by looking at the charts. But hey, Jason, thanks for taking the time. This video went much longer than I thought. If you have any questions, shoot me an email or give me a call. You can call my office at 832-895-1700. Shoot me an email at, you know my email address. So if someone else is watching this, if you share it with a friend or an associate who might need some help managing the risk in their portfolio, please have them email me at jim@familywealthbuilder.com. Thanks, Jason. Have a great day.